All right, it's December 21, 2023. This is our market dissection class, where we jump into price action for a specific day and understand how we played it. If we took a loss, how could we have minimized our loss? And if we got a win, how could we have made the win a little bit better? So we're gonna jump right into it and understand, where price was trading, how the week was trading, what we do, how we look at price, all these different various factors that go into it. So just to start off with, obviously coming into the beginning of the week, we're near the all-time high of the market. We do anticipate at least a small breakout before price potentially has even a chance of reversal or retracement, because when price has a target in mind, it's just gonna magnet to that level. As it's rebalancing price and moving towards that level, it's just gonna keep moving towards that level. So understanding that concept, we know coming into the week that they're gonna go for the highs of the market. Now, when we come in, this is let me see. This is Sunday, Friday. So this is our new week opening gap right here. So I always mark out the new week opening gap to start off the week. So I can take this, extend it over. We understand that Monday came in, they ran price up. And then Tuesday they came in and we still hadn't broken the highs of the market over here. So price ran up again on Tuesday. Came in on Tuesday. Tuesday was a very choppy session, a lot of back and forth movement as price played around in that area. Going into the close of the day, we had a massive push up, which brings us to Wednesday, and it's the day that we'll be covering in this session. So understanding that, hey, market has broken out of its highs. We understand that the market is heavily bullish, that it's given no indication that it wants to, have any sort of retracement, or it wants to have any sort of pullback or rebalancing of price. Obviously, if it was any other situation other than the current situation that the marketplace is in, I want to see efficient delivery. That means any equal lows that are left behind in price from Monday, from Tuesday, potentially on Wednesday before market open. I want to see some sort of liquidity grab off of these levels. I want to see some sort of rebalancing of price to build up the liquidity that it needs in order to go and push further up. However, because of the current circumstances, because of the current situation and the bullishness that the market has been showing in the past few weeks, I wouldn't be surprised if they leave those equal lows behind, the same way that they did during the March rally at the beginning half of the year. So these are all various factors that I was looking at. We're gonna go in deeper into price on the 15-minute time frame on Wednesday. So obviously I have this set to electronic trading hours because I want you guys to be able to see how Asian session left equal lows down here, and how the next day left equal lows down here, and then obviously before session we have equal lows down here. But now, obviously, I always look at the 15-minute on the RTH, regular trading hours. So we're gonna be using this chart on the 15-minute time frame. Wednesday, looking at market open, obviously we anticipate a further drive up because market open is coming in right here. Anytime that I have anything marked out from the day prior and price is relatively close by to where I had marked out on the day prior, what I like to do is I like to extend price over a little bit into the new day to see if the same levels that we were looking at the day prior are going to be reflected in the day that we're playing. So coming in, we see prices opening up over here. Obviously, a previous day closed up here, so my anticipation would be for this thing to go long. Now, as we'll look at on the 5-minute time frame in a second, there was equal lows down here that didn't get taken out. But my anticipation is for some sort of liquidity sweep and then a rally up. However, we just used one of the levels that I had marked out from the day prior, most probably a new day opening gap or something like that. Maybe a FEG left behind in price. But I always just move everything over if it's relatively in the same range. Now, so we have new week opening gap marked. We have levels from yesterday. We understand that Wednesday is halfway through the week, which is halfway through the weekly candle. We know that there is a 70% chance that either Tuesday or Wednesday will set the high or the low of the market for the week. So if Tuesday's chop holds, then most probably if Wednesday can rally all day, then Tuesday's low is 70% chance not going to get run out. But we come in, equal lows, pushes up, and now we'll jump into the 5-minute. So coming into that day, I took the new day opening gap, and I also showed up a little bit late on this day. So I showed up around 7 a.m., which is right here. But just coming in and seeing the way that this price structure looked on this side, the first thing that I did was I marked out all these levels to see if there could be any sort of retracement for us to go long, because we had equal highs up here from Asian session, which we needed to run out. So understanding that, hey, structure has flipped, and all these gaps that we had left behind in price are going to be used as an inversion now. I'm anticipating that we're going to run up and take these highs. Now, how do they want to get there is all dependent upon how much liquidity is built up there. So if they want to flip this structure and they don't want to give an opportunity for people to exit, they're going to rally that thing very quickly to get to that level. So this is the 5-minute time frame that I'm coming into. Let's move this price over right here. Okay. So 5-minute. And now we're down to the 1-minute. So I'm showing up not here, even though I had this marked out for equal lows, because clearly we haven't taken out any of this. However, this was somewhat balanced. So I wouldn't be surprised if they just want to rally it from here and just keep going higher. But I can't come in and I can't anticipate or take a short until the entire structure flips. So it's important to understand where this structure is gonna flip. So coming in at 7 a.m. and just seeing this, remember I marked out the levels and then I come down to the 1-minute. And I see, okay, price pushed up, we had a retracement, and then a little back and forth over here, and we popped up to a new high. So anytime I see something like this, as long as this resistance level, you want to call it, holds, which is also the new day opening gap, if act as support, inversion to go long. Once I saw this candle, understanding that I'm getting into this move at a very late stage in the day and the take profit is only up here, I decided to take this position over here as this candle was popping up, put my stop loss below these wicks and run it to this level to see what's going to happen over there. Cleared out 50% of the position up there, ran the break even, waited for the next move, and I got out of my move somewhere in these two candles over here. Why did I get out of my move? Like, what justifies the fact that I should get out if I'm in the move? And, you know, price has ran in my favor. Well, understand where you got in. Understand that, hey, what's the timing of the market? And what I know about timing is usually from 6:30 all the way up until 7:50, it typically runs in a direction, and then 7:50 has a liquidity grab off of that level. So if I know something like that, and I'm hopping into this move at 7:14, then I know that there's a high probability that my position is going to be returned back to. So as long as my position is floating in profit and it's pulling into profit, further into profit on my position, I want to clear more and more of my position out and eventually be out of the position. It's important to be content with situations like that. Understand the game that you're playing. Understand where you're showing up in the market, what time you're showing up, how the market is expected to behave on that day, and understand what type of conditions you want to be playing in. If I know that I'm coming in and market is playing at a level where it's near all-time high, then maybe I want to be very quick to exit my positions, because there's a chance of retracement, there's a chance of, potential liquidity grab, there's various factors that go into it. There could be a chance of consolidation. So understanding that, hey, I'm playing near market all-time highs, that's not an area to leave a runner. If you don't have runners in on the long side from the entire rally up from the end of October until now, it's too late to have a runner. As if you had a runner on Monday or on Tuesday, you have to understand that as price is pulling away, you have to clear more and more out of your position. You have to reduce that position so much that if it's gonna run, let's say you have 2 micros, 1 micro, maybe you have 10 micros as your runner. But if it's gonna run, great. If it's not gonna run, I've locked in my profit. So these are the things that go through my head when I'm showing up on a day or a condition or a space like the one that I'm trading right now. If I'm entering somewhere and the daily time frame is in an area where this is the last tick to, make a massive move, then maybe I want to leave more of my runner on that position. But how do you know those things? Well, anything that happens on the 1 minute is going to happen on the higher time frame. So if I've played every single day, I know the intraday moves and I know how it moves on the 1 minute time frame, then all I got to do is look for the same setup that I would take on the 1 minute time frame, my entry point, and look for that day in price action on the daily time frame, which is something that we've done a lot of. Come in, hop into a trade, end of the day you're floating up 300 handles, you look back, you're like, I'm in the move at the last tick. Like, you entered, for example, on this day, and there's clear liquidity buildup over here. So you're like, okay, if I'm in on this day and this was the next day, then this thing shouldn't even return back to my position. We should just accelerate straight to that level. And that's how we catch our swing plays. We enter on the 1 minute and we take it all the way through to the weekly time frame. So we understand where we're playing the market. People wonder if we're scalp traders, intraday traders, swing traders. We're all of it, because we just play the market according to what it's showing us, where the market is at, how can we capitalize on it. And that's the point of this session. The session, market dissection class, is meant to understand how price moves and how we could capitalize on the market, whether it's on the 1 minute, the 5 minute, the 15 minute, where price is at, whatever the case might be. So getting back into it, price pushes up, drops down. We've left the FVG behind over here. We're somewhat flipping the structure. So if price returns back over here and it goes short right here, maybe I want to take a position right here. So this was my second trade of the day. I took a trade right here like this. Took the trade on the close of that candle, put the stop loss above that candle. Is this the level I'm chasing? No. But as soon as price gets over there, I'm going to be break even on my position. I want to chase this level. I want to chase this level. Most probably, I'm going to look at the 5 minute to see where potential liquidity is built up. And one major spot that I told the team was 7 a.m. This is where major liquidity is built up. Why this candle? What makes this candle special in this entire move? Well, what makes that candle special is that this was the last time that price had liquidity, that it went for liquidity. How do I know that price went for liquidity on that candle and let's say not this candle or this candle? This is a balanced price range. This is a balanced price range also. But this candle, the 7 a.m. candle, is an algorithmic time, number one. Number two, it took out that low. It took out that low. It couldn't quite make it at that low, but that's a balanced price range also. So this is the last time that market has taken liquidity. So if I'm hopping in over here, my anticipation is that I'm going to get down over here. Does that mean that I'm going to hold the position up until that point? No, that doesn't mean I'm going to hold the position all the way up until that point. Maybe I might leave a runner, but I'm going to look for shorter term levels because I need to understand that I'm playing in a heavily bullish market and I'm trading at the highs, and this market can easily keep pushing up, but the probability of a retracement is pretty high. So when I see something like that, I'm going to take that trade. I'm going to get into that trade right there. So I take that trade right there, stop loss up here, and I'm running this thing for this liquidity. This is my B level. This liquidity, TP1, maybe clear out 20% right there. Wait a little bit longer. I see it tapping over here, another 20% right there, which means I'm out of my position 40% and I got 60% running. After that, wait a little bit, comes back, liquidity grab off of that level, drop down further to start chasing this. Let's scoot this chart over a little bit. And let's clear all these drawings. So in reality, I want to wait to see the full flip. But as it's going in my favor, I want to clear out partials. I want to take positions off the table. So again, right here, the full take profit amount, 7 a.m. candle, this is 7 a.m. candle right here, would have been 1 to 10. But let's say you saw this over here. Now, what is this indicating to me? And this was a conversation we had while market was playing in this area. One of the boys came in and he said, hey, Ryan, is this 5-minute triple divergence on NASDAQ? And I said, absolutely. So we need to understand that. What does that mean? What does it mean to have 5-minute triple divergence? Well, triple divergence suggests that we have a low, and then we have a lower low, and then a lower low. So 1, 2, 3. If you had an indicator on your chart, and there was a strength indicator, or it could be a MACD, or RSI, anything like that. In these areas, it's going to show you an oversold condition, but the oversold condition, as price is moving like this, the oversold condition is going to be moving like this, which is triple divergence. As the indicator moves down, or as price moves down, the indicator moves up. So it's losing its steam. So seeing that, price starts rallying. So I'm short bias from here all the way up until here. So where do you think my next trade was? Knowing that concept, I'm out of this. I'm out of this completely. I took full profit somewhere down here. So I closed out 20%, 40%, and then I waited, closed out another 20% right here. So I closed out 60%. I have another 40% running. Got a little scared over here. I'm human. Closed out another 20%. So I close out 80%, I have 20% on, and I'm out of it completely. I don't care what the dollar amount is on that position. The chart is telling me to exit my position and to flip my position to go long. So now we have to look at the timing of the market in this area. So here's the next position. The next position is a long right here. So we have this push up, we have this candle down, FEG created right there. So let's mark that FEG out. Just very small FEG right here. From here to right there. That's the FEG right there. I see left leg lower, candle pop up. That's my entry. Candle, the stop loss would be right below that candle. Where am I targeting? Equal highs. Equal highs left behind in price. Straight up. 1 to 5 trade. Since I had profited on this move, I'm playing this a lot smaller. I don't want to risk the profit that I made here or the profit that I made here. This is where you look at the number. This is where you look at the number and understand that this is the market I'm playing in. This is how much I've made on the day. This is what the market was willing to give me, not what I was able to force out of the market. The market is not there to pay you, it's there to take money away from you. So knowing that fact, I know I have to play this position a lot smaller. Let's say I made $500 on this move and then another $350 on this move. Let's say that's the situation. But I see that there's liquidity buildup right here. Well, what did that do? TP. That's TP. I have to get out. I have to get out, and I'm looking at the time of the market. What time in the market am I trading in right here? Well, what do we know about that time? We know that at that time, which is 8:30-ish all the way up until 9:15, 9 a.m., lunch hour, the market has a chance of potential reversal to target liquidity. Well, I always look to see where is liquidity. We have triple divergence. Is there liquidity there? No, there's no liquidity there. It's been taking liquidity. Every time it taps into a deeper sell side, but buy side remains. Understanding that buy side remains, and this is a major level. This is yesterday's high that I have marked out over here. I understand that, okay, this is something that I have to pay attention to. Now, when I see this candle, that's where I mark this line out. What time is that at? So I'm in this trade. It's attacking in liquidity, which is placed up here. And price goes there. And then from 9:02, which is immediately as the candle opens, right? 9:02. That's it. I know that 9 a.m. 1 hour candle pushed up, and there's no lower wick to this candle. So the 1 hour candle looks something like this. It has no bottom wick, and it just pushed up, and then it has a wick. And this is the first 2 minutes of the hour. Most probably, this thing is going to wick all the way back down, flip this candle a little bit at the very least, create a lower wick to go then push up and paint like that, right? So I know that there could be a potential drop over here. But again, I'm human. I make mistakes also. So looking at this, I still see the equal highs up here because this didn't take this out. And if that's supposed to be taken out, then most probably we're going to go through this gap that was created right here. So knowing that fact, I took a long, I put my stop loss a little bit lower than the 9 a.m. candle, which was right here. Inside this FVG marked out on the 5-minute time frame from back there. I'm going to clear everything. I see that over here, price drops down, takes out liquidity, taps into where? Taps into new day opening gap. Shoots up. I see that, okay, we had a hard drop. This thing has a chance to come straight back up. What does that mean? Rebalance. If price drops, comes back, and this candle right here is a very important candle. Let me zoom into that candle so you can see what I'm talking about. This candle right here. If this candle can break this, that means the entire structure just flipped. So this is a balanced price range. Anytime you have something like this, it's a balanced price range. Well, what does that candle look like on the 15-minute? Look at that candle. Is that a healthy candle? No, that's not a healthy candle. All my guys know this already. But that candle, this wick needs to be retested. At some point on this right side, this wick needs to be retested if price is to long from here. So I know that it's balanced, but I would like to see this FVG stay open right here. So knowing that, let's move forward with price, because this is my next trade right here. Took it right here, put the stop right below this candle, ran it to the left side equal highs that we had, which is right here. Right there. That. So from here to here. Cleared out 50%, left the runner, price drops down, pushes up. What do I know? It's 10:06. Where my cursor is at is 10:06. I still have equal highs. We're in the middle of nowhere. We have this as support right now. So I'm going to scroll this over just slowly so you can see how this thing traded. Right here, if I wanted to get a very risky short, that's the spot. Why is that the spot? That's where I originally shorted off from. If that breaks, this thing flips. And this thing will use this as support and go up. So, if I'm in here, I cleared out 50% up here. And then I waited, and I'm seeing this. And I see this drop down. I'm clearing out another 20%. I've already capitalized on this move, which was from here to, let's say here, 30 handles. From here down to here, 36 handles, 66 handles, let's say. I also took a hit right here, and the hit was about 7 handles. So let's say 59 handles I've capitalized on. I took this trade from here to here. Let's say 20 handles. So 59 plus 20, 79 handles is what I'm profited. And then from here to up here, let's say another 25. So I'm at 100 handles on the day. In reality, you could stop. You don't have to trade this how I'm explaining it to you right now. You catch that first 30 handle move, you could be done. Be content. That's it. You're done. You made money on the day. Did you win or did you lose? You won. But for the purposes of education, we're talking here in regards to how perfection would be played. So understanding that, okay, we're at all-time highs. This is all-time high on the market, other than this wick right here. That's all-time high. This is all-time high range up here. There's a high probability of reversal in the PM session of the day. For what? What's down here? Liquidity. This right here, that's liquidity. There's stops down here, there's stops down here, there's stops down here. Oh, wait, we didn't even take out the 7 a.m. Where's the 7 a.m.? Look, this is the gray box. This is the 1 minute time frame, gray box. Did this take this? Nope. Doesn't have to, but this is the last time that it took it. So, understanding that this is the last time that liquidity got swept. Most probably, I don't even want to see a return back there. If this is a long, I don't want to see a return back there, because that should have built up enough liquidity to drive this thing higher up, which means that the only place left to take liquidity would be right here. So this tap. And this tap left me with a candle that's not a healthy candle. So if this candle's 50% breaks, I need to flip my bias to short. Look at this. The 50% lines up with the FEG created in price. Price trades down. Price trades down. This level that I have over here, if I were to take this entire day from market open low to market open high, 50% lines up right here. So this is the 50%. Where this bounced off of is the 50%. Anything that's deemed up here is in a premium on the longs and a discount on the shorts. A lot of people talk about premium and discount. Why don't you explain it like that? A premium on the long and a discount on a short. It all depends on what the market wants to do at that stage, right? So what is it telling me as time is progressing? As time is moving forward, what is the market telling me? Well, let's look into it. On the 1 minute time frame, we're going to dissect this price action. We have this drop down off of the last FVG. We have something created right here. So if I were to mark out this spot right here, if I were to take the opening of that candle and extend it over, we have a minor push up off of that level, come right back into it. We try to push up, weak. 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 Okay, we know we're coming for this wick now. Which is this, which is the balanced range, which it shouldn't even tap into. But if it does tap into, I would like to see it stay from the 25% to the 50%. I don't want to see it go down any further than that. But what is this? Is this triple divergence? No. That's 1, 2. I need a third one. But the third one would bring price into an area that I don't want it to go to. But that's like the final level that I can allow this thing to trade back into. Because if I were to mark out, let me delete this. If I were to mark out the 50% of this candle, the 5 minute, not the 15 minute, the 5 minute wick, the 25% to the 50% is this box that I have marked out right here. Does this box come in below that FVG? Yes. So if price drops down right here, this is its final attempt. We swept liquidity off of that low. This thing is flipping. If you're going long, that's your entry right there. But this thing should just hit this and go. The second this candle flipped, my entire bias changes. That 1 minute candle made its decision. Now, since we know what the decision is now, is this in a discount or a premium? This is a discount because the bias is short now. You have to understand that spot in the chart. Every single day, every single day, every single week, every single daily time frame chart, weekly time frame chart. I don't care what chart you're looking at, what time frame it is, whether it's the 15-second, the 1 minute, the 5 minute, the 15, doesn't matter. If you can't determine where the structure flips, you got some work to do. Because on that candle, everything in my head changes. This candle right here, which is 11.18. And the way that this thing is going to move down is not going to be normal. This thing is going to go for liquidity off market open lows quick. Why? Why market open lows? Because everything else got balanced with the 7 a.m. and the 7 a.m. is down here. Look at how we move through the 7 a.m. Look at this right here. Let me zoom in so you can see it. So we're looking at this candle. I'm going to be on the 1 minute chart. Look. Went right through it. Butter. It went butter through it. Why is that? Because they're not chasing that candle. That was already, that it shouldn't have come back there. They're chasing that. Now, knowing that I've played this setup so many times where market pushed up, took the entire lunch hour, PM session, early session to set it up, but around 10:30 usually, hint, hint, it sets up. Starts dropping, rebalance, drop, heavy, very heavy price action. This candle is the last, this is the last time it has the opportunity. Second that thing snaps, this candle you're entering. Now, did I enter it? No, I didn't enter it. But I love to see it because I want to see that efficient delivery. I'm already up 100 handles on the day. I don't need to enter it. I don't need to do anything. I don't even need to trade. No one listening to this video right now, nobody in this team right now needs to trade. Because these moves will repeat day in, day out. So the second this thing flips, one of our guys, he took a short here. He was in the long down here because he knew I was talking about how this is the last spot it could long from. The second he saw it approaching his stop loss, he just clicked the reverse button. Jesus Christ, why did I do that? He hit the short. Where is he chasing? Market open. What's below market open? Equal lows. That's a 1 to 12. Look how fast it got there. This is a 70 handle move to the downside. But wait, there is more. Anytime you see a move like that, it's not just going to take out whatever is on the left-hand side. That's the full flip. That's the full flip. Anytime you have market open, drive up heavy, and then come in and flip, this thing isn't just going to market open lows. This thing is flipping the entire structure. So this is TP1. Where's TP2? Where is TP2? And walk. The new week opening gap. All the equal lows we left behind from Monday, from Tuesday, from Wednesday, everything in between. It's just going to go straight there because it doesn't want you to have the opportunity to close the long position. Understand that. Understand that, hey, we left equal lows Asian session Monday, equal lows Tuesday, equal lows Wednesday, belonging nonstop, heavy rally mode, heavy rally mode. In order to make price efficient, it needs to just go straight there. Straight to NWAG. Clear everyone out. Clear everyone out of the long. So where does it go? NWAG. Now from here to here, 217 handles. That's the first retracement right there. That's the first retracement. Now, if I look at that on the 15-minute, you had that candle wick, which is this. This candle's wick. This one taps into this inefficiency left behind. You have two massive candles. It's not going back there. That's a breakaway gap. It's going to drop lower. So guess what I did? I shorted this right there on the right leg. Very late day, late session, but I've seen this play. I know how this thing is going to trade. So whenever I see this thing right here somewhere, I think it was, I shorted it to catch this low. Cleared out the full position down here. But from here to here, check this out. 70 handles. Just that is 70 handles. So I bagged 170 handles on the day. The guy that took this trade got a very nice profit off of it. Doesn't have to trade all month. His profit was so large on this move, he didn't have to trade all month. He doesn't have to. It's a Merry Christmas. It's an early Christmas, Merry Christmas. Go enjoy your holidays. See you in the new year, buddy. But that's how you play this game. So, hopefully you found some of this insightful. Give this video a like and subscribe to our channel. If you guys want to trade with us live, the business link is in the description. Hope to see you guys there. But if not, we'll be posting one of these every week. Moving forward, we won't be posting too much. As we roll into the new year, these market dissection classes are supposed to be exclusive to our team elite. So we're not going to be posting too much on YouTube moving forward. If you guys want to learn, you guys are more than welcome to join in.